Okay, there are people in the waiting room, so we're just gonna wait 2 or 3 minutes. Okay, I think we can kick off. Please note this live session is being streamed on our platforms, on our YouTube channel, as well as all our platforms, LinkedIn and Facebook. Thank you everyone for joining. Over to you, Shane.
Are you looking for a trusted partner to enhance your organization's internal controls and ensure compliance? Welcome to Brandmore Advisory, where we specialize in internal audit, risk management, governance, and performance management services tailored to your unique business needs. Our team of experts is dedicated to providing comprehensive internal audits that identify inefficiencies and uncover opportunities for improvement. We help you navigate complex risk landscapes, ensuring your organization is prepared for any challenge. With our governance services, we strengthen your decision-making process, promoting transparency and accountability at every level. Our performance management solutions empower your organization to achieve its goals by aligning individual performance with strategic objectives. Join the many organizations that have benefited from our tailored solutions and expert insights. Choose Brandmore Advisory for a brighter, more secure future. Visit our website at www.brandmore.com or contact us at 011-0263-052 to learn more.
Thank you very much. So thank you everyone. Welcome to Brandmore's webinar, where we talk about different topics. So today in the session, I want to welcome everyone who have joined us on the Zoom, everyone who is joining us online on our YouTube, and everyone who is on LinkedIn as well. You are all welcome. So today's webinar, we will be, actually just before we kick off, today we'll be talking more about provisional tax. Can you share the slide, please? So in this webinar, we are actually, this is our 10th webinar that we are hosting. We are so pleased that we have been hosting this. This is our 10th one. So in this webinar today, we will be talking about provisional tax, the basics of provisional tax, and what you need to be aware of, both from individual and corporate perspective. So the speaker of the day is Tendai Rushesha. She is one of our senior consultants at Brandmore. She is also a tax practitioner and a audit senior as well at Brandmore. So just a brief of introduction. I think you've listened to our video that we played now. We are a dynamic and professional firm based in Midrand. We also have a branch in Zimbabwe and in UK. The UK, we are still setting that up, but we do have a branch there. We call ourselves accountability partners. The reason why we call ourselves accountability partners is because we actually live by this daily. Our duty and aim is to grow businesses. So just in brief, this is our services. We offer secretarial services, your company registration, company amendments, and we actually branching into governance as well. We have having a key person that is joining our firm that will look into the governance of companies. We also offer consulting, business processes, performance management, and the setup, because these are the key things that you need as a company for your business to grow. We also registered auditors. We do both internal audits and external audits. Then audit readiness as well, for if you want to cut off time and costs, you need to be audit ready, and we offer that service. We also have payroll, human resources services, and tax services as well, where you have, if you have any tax disputes in an individual perspective, tax returns, all those kind of tax-related services will be able to assist you, and your normal accounting, your bookkeeping, management accounts, your financial statements. So just as a way of introduction, before I just hand over to Tendai, my name is Molen. I'm also the Managing Director of Brandmore Chartered Accountants. Then I'm going to hand over to the speaker of the day, who is Tendai Rushesha, who is going to take us through the objective of this seminar and what we are going to cover in the seminar. Over to you, Tendai.
Okay, thank you, Molen. Good morning, everyone. My name is Tendai Rushesha. Is introduced by Molen. I'm a registered tax practitioner, and I'm also an audit senior at Brandmore Accountants and also a senior accountant. So today we'll be speaking about provisional tax, mainly what is provisional tax, who should pay provisional tax, tax threshold, and then when is provisional tax payable, the implications of late payment, and also late submission of provisional tax, how we can calculate, and also payment of provisional tax, any other mitigation strategies. So that is what is actually on our objectives for today. So without further ado, I would ask the people that have joined the webinar, would like to get to know you. What description best fits you? Are you a business owner, accountant, sole proprietor, or other? Okay, I think everyone has put in a response, so we can continue. End the poll. Okay. Okay, so we can start with our webinar on provisional tax. So basically, what is provisional tax? In short, provisional tax is an advance payment of income tax that companies and individuals make to the South African Revenue Authority. So basically, with provisional tax, it's not like a separate tax, but it's more like an advance payment of income tax. So it's an advance payment that is going to be done for your income tax. And also, it's a way to spread the tax burden over the year rather than paying a lump sum at the end of the tax year. So in short, what I'm just trying to say is that with provisional tax, it's a prepayment of your income tax at the end of the year, but it's subject to legislative requirements on when it should be paid and how it should be calculated. Okay. What is a provisional taxpayer? So who pays provisional tax? So with regards to companies, all companies are provisional taxpayers, except indicated otherwise in the upcoming slide that we'll discuss later. With individuals. So with individuals, there are individuals that qualify to be provisional taxpayers. For individuals who qualify to be provisional taxpayers, that is any person who earns income other than salary or remuneration. So what do we mean when we say that a person earns income other than remuneration? It means that when you're earning remuneration, your employer withholds tax, which is PAYE, which is pay as you earn on a monthly basis. So basically, if you're not a salary earner where your employer withholds pay as you earn, then you should be a provisional taxpayer. However, in certain instances, you would notice that when you receive other income that is that is not your salary, like that is not taxable on a monthly basis, SARS can automatically register you as a provisional taxpayer because it would have exceeded a particular threshold that they have to indicate that no, you're not supposed to be registered as a provisional taxpayer. So in the next slide, I'll give you examples of income that I mean that is not salary, where it exceeds a certain threshold, where SARS automatically registers you as an individual for provisional tax. So an individual qualifies for provisional tax when you're a sole trader, that is, you're running a business as a freelancer, or you're trading in your individual capacity in your own name. Also, partners in a partnership, individuals who receive taxable non-employable income. So I've already spoken about this on how individuals who are non-salary earners are provisional taxpayers. So the total taxable, where your total taxable income is greater than the tax threshold. So examples of the other income that I meant, that if you're not a salary earner whose PAYE is not being withheld on a monthly basis, they are like your rental income, things like investment income where you receive interest and dividends. But however, remember, with these interest and dividends, they are subject to different exemptions. So we'll dwell on this in our next webinar when we speak about individual taxes, where you receive other income from your employer, where your employer is also not registered for employees tax, then it should be a provisional taxpayer. So in summary of the part that I have taken you through, the key pointers are that if you earn income, if you're an individual, if you earn income that is not subject to your employer does not withhold PAYE, and it exceeds a certain threshold, then SARS automatically registers you as a provisional taxpayer. And also, if you're not a salaried employee, if you're not a salaried individual and you earn income, then automatically you become a provisional taxpayer, because on a monthly basis you don't have an employer who's withholding your tax. Okay, we'll move on to the next slide. So as I mentioned, I said with companies, they are all provisional taxpayers except indicated otherwise. So these are some of the exclusions from provisional taxpayers. These are PBOs are not provisional taxpayers, recreational clubs, body corporates, a natural person who does not receive income from carrying a trade. So basically this means it's an employee, is a person who receives salary. Then you are not going to be a provisional taxpayer, or when your income does not reach the tax threshold, then you're not a provisional taxpayer. We also have deceased estate, where the deceased estate is not a provisional taxpayer as well. Okay. Right. So what I meant by the tax threshold, I meant that, so up until you get, depending on different age ranges as indicated on the screen, if you're under the age of 65 and you earn 95,000, below 95,750, then you don't exceed the threshold, then it means that you are not going to be a provisional taxpayer. If you're 65 years and older and you earn income that's 148,000, that's below 148,217, then you are not a provisional taxpayer. Same applies to when you're 75 and older. If you earn any income that does not exceed 689, sorry about that, then you are not supposed to be registered as a provisional taxpayer. Okay, that's on tax threshold. Before I move on to when is provisional tax due and payable, do we have any questions, or I can move on? Okay, all right, I'm going to continue. So when is provisional tax due and when is it payable? So with provisional tax, there are two obligatory periods where you have to pay provisional tax. So if you're a provisional, if you So the first criteria is to determine that do you fit the criteria of being a provisional taxpayer or you don't? When you qualify, then it means that you now need to determine when is the provisional tax due and when do you have to pay the provisional tax. So in terms of the SARS Act, there are two obligatory SARS periods that you have to pay provisional tax. There's the first provisional tax, and then there is the second provisional tax. Then also there is a third provisional tax, but however, this is not obligatory. This is an optional provisional tax payment. But I'll get to it as I speak about the different periods that you have to pay provisional tax in detail. So the first provisional tax is due after the year end of a company. So for example, let's say your year end is February, 6 months after the year end, your first provisional tax is due in August. If say your year end is December, it means that your first provisional tax is due 6 months after December, which means it's due in June. So basically how you need to determine that is to say, when is my year end plus 6 months? And then in that 6th month, that means that is the month that you have to pay your first provisional tax as a company. For individual provisional tax, the due dates for submission is the same, is 6 months. And remember with individuals, the standard year end is February, if I can put it in that term. So which means for individuals, the 6 months period falls in August and it doesn't change. If you're a provisional taxpayer who is an individual person, it means that your first provisional tax is due in August. Okay, and then your second provisional tax. Then your second provisional tax now is due at the end of the tax year, which means that if I have declared my first provisional tax in August, then my second provisional tax is due in February. So if I can take us back to how we get to which period are we actually declaring provisional tax. So if you get back to the first slide where I explained that provisional tax is a prepayment of tax. So let's say right now we are in the 2025 financial year. If you have a February year end, the 2025 financial year, it runs from the 1st of March 2024 and ends on the 28th of February 2025. So that is what we say is the 2025 financial year. And then now your provisional tax will be 2025-01, which means it's a first provisional tax payment for the 2025 financial year. And that is the first provisional tax. Then 2025-02, it means that as the provisional tax as at the end of 2025, at the end of February 2025. So that's how provisional tax works in terms of timelines, to say, what are you actually prepaying for? You're actually prepaying for your income tax that is due at the end of your financial year, at the end of your financial year, if I can put it that way. So with regards to the third provisional tax is optional, and it's not obligatory to say that you have to pay third provisional tax. It's usually used in the sense when you actually want to avoid interest and penalties, because I'll speak on that in the next slides on how we end up getting underestimation penalties or late submission penalties. But right now, I'm just going to speak about it as it is. So when you want to avoid underestimation penalties, SARS gives you an option to make a third provisional tax payment, which is an optional tax payment, where you have said, okay, my first provisional tax, my second provisional tax, I don't seem to have estimated it correctly. I need to do a third provisional tax. But take note that you can't do a third provisional tax if you have already declared your tax return. So in terms of the Income Tax Act, the income tax, I'm speaking of companies at this point. So in terms of the Income Tax Act, if your year end is ending 28 February 2025, the tax return is only due a year after the end of the financial year. So let's say you are a company that wants to ensure that their tax returns are submitted on time and you don't have to wait for last minute. If you declare your income tax return for year 2025, and you have paid your first and second provisional tax, but you have already, at the end, after paying second provisional tax, you have declared, you can't do a third provisional tax, because as soon as you declare your income tax and you have underestimated your tax, SARS, that as soon as the assessment comes, it already comes with an underestimation penalty. So the third provisional tax would work better if you haven't submitted your tax return, but you now know that you have reached 28 February, but then you have underestimated and you would want to make a third provisional tax payment so that you avoid the underestimation penalty. That's when the third provisional tax works. So the third provisional tax should be made within 11 months after the end of the tax year. So you see, this one links with what I was saying, that the income tax return is only due 12 months after the end of the year. So let's say you haven't submitted. And then if you have a February year end, and otherwise, so remember, with companies, they have different year ends. So if you have a February year end, then your third provisional tax can be done within 11 months after the tax year. If you have a different year end, the third provisional tax needs to be done 6 months after the end of the tax year. So the above payment is usually done when the first and second provisional tax payment was not sufficient, so that you avoid underestimation penalties, underestimation interest and penalties. Okay, so that's the third provisional tax. Okay, so in the next slide, we'll speak about how you can calculate your provisional tax, both as an individual and as a company. So a provisional taxpayer is required to estimate your taxable income for which provisional tax return must be submitted. So now we are going back to saying that, okay, now I'm gonna use the example of February year end because excuse me, because most companies have a February year end. So a provisional taxpayer is required to estimate the taxable income for which provisional tax must be required. So as at February, that will be your year end, which means your first provisional tax is due in August. So now, for you to determine the provisional tax that you're supposed to pay in August, you need to determine what we call an estimate taxable income. So a provisional tax return still needs to be submitted, even if your taxable income is zero. So remember, even with any tax, even with any tax return, if it's zero, it still needs to be submitted. So provisional tax follows the same line. So let's say you have calculated and you've seen that, okay, no, at this point, my calculations indicate that I'm not having any taxable income for the 6 months. Then you still need to submit the tax return indicating that it's zero. We also need to pay attention to the fact that whatever we declare to SARS as the first or the second provisional tax, we need to be able to substantiate it because in certain instances, SARS can come and just say that, what was the basis of your calculation of your first provisional tax? What is the basis for the calculation of your second provisional tax? So we need to ensure that when we are calculating and determining the amounts, it needs to be done correctly, either by a person who has knowledge of tax or by outsourcing it to registered tax practitioners. So the first and second provisional estimate amount cannot be less than the basic amount. So what I mean by the basic amount is that it's a taxable income assessed in the previous year. So if you have filed an income tax return, after you file your return, SARS issues an assessment to either agree or to either request supporting documentation to say that for us to confirm that this assessment is correct, you need to put supporting documentation. So that is what I mean by assessment. So there's a final assessment that SARS issues. So it's either SARS does not request additional supporting documentation, or it does, and then it issues a final assessment. So that is the final assessment. The final assessment, in short, is basically what SARS is based on what you have submitted, what SARS is agreeing to, or what SARS is corrected and given you. So that is what we say when we say assessed tax. for the preceding periods. So in estimating the taxable income, whatever we estimate, it does not need to be less than the basic amount. So yeah, estimating taxable income. So a thorough consideration of previous assessed periods is essential when determining the current tax liability. So when I mentioned that when we have an assessment that has been done, for example, if you file a return for 2024, SARS assesses that tax return. For us to determine the basic amount, we are saying that what periods have been assessed. If the period that has been assessed is more than 18 months, so let's say you haven't submitted your tax return, and the period between the last assessment and when we have to do the first provisional tax is greater than 18 months, that means that you need to increase whatever taxable income that was last assessed by SARS by 18%, and then that becomes your basic amount that you're going to use to declare. That becomes your basic amount, which cannot be less than the taxable income that you will use to determine your first provisional tax payment. So in short, that is what we mean when you're saying the basic amount. Okay, so the notes on the screen, they can be a bit technical, but I just tried to make it as short as possible to say what is an assessment. When our last assessment is less than 18 months, then we have to increase the last taxable income by 18% for every year that is complete. So which means you increase by 18%, and then that will become your basic amount. So for calculation now of provisional tax as an individual, to calculate your provisional tax, firstly, you need to estimate your taxable income for the entire tax year, because when you're determining your tax, the SARS tax tables, they cover an annual basis. They are not on a 6-monthly basis. So you need to determine your taxable income for the whole year. And then after you have done that, you calculate your tax on that annual taxable income. And then if it's now the first provisional tax, then you divide the total tax, which is what we would have calculated on an annual basis. You divide by 2, and then you get the estimated tax for the first provisional tax. And then you deduct if you have paid any other form of taxes. Like this one applies when the employee's tax applies when you're both a salaried employee, and then you also earn other income that is not remuneration or income that the employer withholds PAYE. And then you deduct any allowable foreign tax credits, you deduct any rebates, any medical credits, and then the result will be your provisional tax that is payable for that period. So for example, let's say your estimated taxable income for the year as an individual is 200,000. So given that the annual tax amount on that 200,000 is 36,000. So the 36,000 becomes the 36,000 is the annual payment of provisional tax. But because you're estimating at half a year, that is 36,000 divided by 2, which becomes the 18,000. Then you deduct other form of taxes that would be payable, like your foreign tax credits and your rebates. And then the lower amount becomes your first provisional tax that is payable over that particular period of time. So how the second provisional tax payment works now is that you follow the same process, but you need to re-estimate again your taxable income at the end of the year, and then deduct the first provisional tax, because it's now a tax that has already been paid. Then the lower amount becomes your tax payable for the second provisional tax. Okay, this was for individuals. Okay, so this covers the second provisional tax, which I have already done. And then for companies, when you estimate your taxable, you also estimate your taxable income for the entire year. And then depending on what you are, you're an SBC or you're no longer an SBC, because remember, with an SBC, with a small business and a bigger business that exceeds 20 million, you're taxed at different rates. An SBC has got is taxed on a sliding scale, and depending on the income or depending on the taxable income, And then a business which exceeds, which is not an SBC, is taxed on 27% of the taxable income. So it will be a flat rate of 27%. Okay, so now that's what you need to determine. Are you an SBC or are you a normal company? Are you are you a company with turnover exceeding 20 million? Then after you estimate that, then you use those tax tables to determine what will be your annual tax. Then you divide that by 2, and then you deduct any applicable foreign credits that will be applicable in that particular period. Okay, the same applies to the second provisional tax. You just deduct the first provisional tax from the now estimated tax annual tax, and then you get to the amount that is being paid for the second provisional tax. Okay, so now we are now speaking on the penalties and interest. So what are the implications if you either underestimate provisional tax or you pay your provisional tax later than the stipulated date that you have to pay SARS? So I'm going to speak of the underestimation penalty and how it arises. So when you submit your provisional tax return, and the returns require you to estimate your taxable income for the year, SARS assesses your final tax, right? So let me give you a practical example to say we are in the financial year 2025, and then we declare our first provisional tax if we have a February year end in August. We declare a second provisional tax in February, and then now we have declared to SARS to say our estimated total taxable income is 50,000. And then now, when we submit the return indicates that no, the tax that is payable over that particular period of time is 60,000. So which means that you have declared 40,000, and then your final income tax return, which you are going to submit before the end of the next financial year, you have said that you also, I think I said 70, let me just say 70,000. There's a 30,000 difference between 40 and 30. So SARS will then say you underestimated your provisional tax, and then you have to pay 20% of the underestimation. But that is subject to different provisions depending on whether your taxable income exceeds 1 million or it's less than 1 million. So in short, when we are determining the provisional tax, we need to ensure that it's done by an individual who has actually done the assessment and also projected to determine to say, okay, if my taxable income as at August or as at June is sitting at 5 million, what is the projected 12 months taxable income that I'm projecting to actually have as taxable income? And also the person needs to have knowledge with regards to what would happen if I have underestimated. What should I do? Let's say I've gotten to February and then I have underestimated my tax. So there's an option for third provisional tax. This works before you have submitted your income tax return for that particular year that you have paid for provisional tax. So we need to just ensure that when we estimate the provisional tax, we estimate the estimation is done by an individual who's well versed with the tax act, or should they be need, they have consulted with the registered tax practitioner so that they can determine that no, we have declared this correctly. And then should we have estimated incorrectly, what are the next steps? Because 20% of an underestimation, it's a fruitless and wasteful expenditure for a business that a business can actually avoid if the necessary steps are taken before the declarations are made or after the declarations are made and they have consulted with the applicable people. So with an underestimation, how it works. So a penalty, an underestimation penalty is imposed when a provisional taxpayer underestimates the taxable income for a particular year of assessment. So the penalty is imposed if the estimated taxable income is used for purposes of the taxpayer's second provisional taxpayer is less than 80% of the final tax payable. So basically what they are saying in short is that if you if 80% of your final taxable income for that year is less than what you have declared, then it means you get an underestimation penalty if your taxable income is more than 1 million. So let's say your taxable income is 1 million, and then we have estimated our taxable income to be a particular amount. If 80% of my final tax is less than what I have declared, it means that you have a 20% penalty of the underestimation. However, the same applies when your taxable income is less than 1 million, then it caps it to say if 90% of your taxable income, if 90% if what you have declared is less than 90% of the taxable income, the actual taxable income, if 90% of that, then it means that you have a 20% underestimation penalty. So that's the technical side of everything, to say, okay, do you earn 1 million or not? Yes. Okay, I earn 1 million. The taxable income was more than 1 million. Okay, so if I say my total actual taxable income, 80% of it, if I'm getting 50,000, and then I have estimated to say 40,000, then it means that I have a 20% underestimation penalty, which is quite steep. So in order to avoid that, we need to ensure that all the provisional tax submissions that are done between August and February, between March and February, and between March and August, and then August and February, they are done correctly, and yeah, using the correct projections. Okay, so this is the same information, although the other one was just a bit detailed with regards to how you end up getting an underestimation penalty. Okay, so the other penalties and interest that you might incur, so if you're a provisional taxpayer and you fail to pay the full amount in the specified period, so SARS will impose another penalty that is 10% of the unpaid amount. So let's say if you have declared your provisional tax to SARS, it needs to be paid. If you don't pay within the stipulated time frame, SARS will impose 10% on the unpaid amount. So, which means that if you're a business earning higher, or if you're a business earning a higher amount, a higher revenue, and which means which is usually results in higher taxable income, it means 10% of the declaration that is made to SARS will be the penalty if you pay the amount late. And even if you are late by 1 day, SARS considers that as a late payment, which results in you incurring late payment penalties. So SARS considers you to have submitted a zero return, hence why they are going to charge a penalty if you haven't submitted your return, or if you have paid your provisional tax late, or if you haven't paid up until the deadline that is stipulated by SARS. So unless your actual taxable income is actually zero, so this will result in 20% underestimation penalty again being imposed. So a scenario, what would happen? Let's say if you have been penalized for late payment on your provisional tax payments, and then your annual assessment shows that you have also underestimated. So what SARS does is that SARS will not demand the full. Now I'm speaking about the penalties and interest. So remember, I said late payment 10%. Underestimation 20%. So let's say that happens at the same time frame. So SARS will not demand the full amounts for both penalties, but you're still in for an extra charge. So in this case, the underestimation penalty will be reduced by the late payment penalty that has already been applied. So if you have both an underestimation penalty and a late payment penalty, SARS reduces the underestimation, because that's the higher, it reduces by the amount that would have been paid as interest on late payment. Okay, so what can a tax professional do a tax professional is required so that they can help you assess your financial situation comprehensively. And they'll help you estimate your taxable income accurately, because as a tax professional, you would be in a position to assess, to say, okay, if a business is sitting on this particular taxable income as at August, what is the possibility that it would move from 5 million to 10 million? And you do the reasonability assessment of it. So they can also help you claim eligible deductions, and also stay up to date with the tax changes, manage your provisional tax payments also effectively. So by engaging a tax professional, you can significantly reduce the risk of underestimation penalty, and also ensure that there's optimum tax planning in the organization. Okay. So to ensure that you meet the compliance requirements, these are other things that you need to also consider as a business, to ensure that you maintain accurate and complete financial records, which is also crucial for tax compliance. So companies must keep records of all income, expenses, assets, and liabilities, as at any point SARS can require supporting documentation for the different tax types. If you're registered for VAT, they can require support. So you need to ensure that you keep your records at all times, and these records should also be sufficient to support the information provided in the tax returns to enable SARS to verify the company's tax position. Also, to add on to that, if your record keeping is at par and SARS is declining a submission that you have done, there's also reduced back and forth, where you now have to do disputes, and it's a reduced admin. It reduces the admin at the end of the day if your records are actually in place, because if SARS declines a submission and requests for additional supporting documentation, if your records are not in place, SARS will give you for at least 21 business days, depending on the scenario. And if your records are not in place, 21 business days might not be sufficient for you to put everything in order and submit to SARS, which would result in additional liabilities for the organization. So record keeping is also key. And the key types of records that you need to maintain, things like invoices, receipts, your bank statements, payments records, inventory records, payroll records, your depreciation schedules. And then I'll just mention the part for the tax clearance, in that, as I have mentioned, to say that you need to be tax compliant with all your tax types, including the one that we're speaking about, which is provisional tax. So basically, you cannot generate also a tax clearance certificate if any of your tax returns are pending. You can also not do a debt arrangement should you be in a position to say, no, we have declared this, and we require to have a debt arrangement with SARS for either 6, 12, 1 to 5 years, depending on the scenario. You cannot do that if your tax returns are pending, if you have pending tax returns. So basically, it's in line with the tax clearance certificate, which is a document where SARS confirms that all your tax affairs are in order. So it is often required for various business transactions. For example, if you do tenders, if you do selling of assets, and the likes. So to obtain a tax clearance, it generally needs to be, you are registered for income tax as soon as you register your company, and you need to have submitted all your returns. And then in terms of your liabilities, also, you need to ensure that all your liabilities are in order. So this slide basically details to say how do the tax returns, non-submission of tax returns affect how a business is going to get a tax clearance. If your tax affairs are not in order, you can't generate a letter of good standing. You can't get a tax clearance certificate, which would disrupt different business activities that you might want to engage in. So we need to ensure that all the tax returns are submitted on time, or debt that is in place is paid, or alternatives are put in place through consulting with a registered tax practitioner who can actually assist you to say, these are the options that we have. Are we going to do a compromise? What options do we have in place for us to ensure that the business gets a tax clearance? So, okay. So the other compliance obligations, like I have mentioned. There are different tax types. If you're registered for VAT, you need to ensure that your VAT returns are submitted. If your turnover has exceeded 1 million, you need to ensure that you are also registered for VAT. PAYE, if you employ individuals, companies must ensure that they are registered for PAYE so that they can pay SARS on behalf of their employees. PAYE goes in line with the EMP 201s, EMP 501s. So these ones are now the tax returns that need to be submitted to SARS. So this is just explaining in detail today what other tax types are there besides provisional tax that needs to be that you need to have submitted to SARS to ensure that you're compliant at all times. Okay. Do you need help filing your provisional tax or any other tax types? If yes, you can comment on the poll. Okay. Or you can comment on the comment section. Respond to Brenmo or Hazel.
Okay, I think people have commented. I think 31% need help. Hope Hazel and Kian, you've taken those details. Okay, we can move to the next slide, Renee.
Okay. All right. So, in conclusion, understanding your provisional in income tax is essential for South African companies and for individuals also who are provisional taxpayers to comply with your tax obligations and minimize tax liabilities. By following good record-keeping practices, meeting filing deadlines and also considering tax planning strategies, companies can enhance their tax efficiencies and avoid penalties. So in short, you need to ensure that besides provisional tax, that was the main topic for today, you need to ensure that all your tax submissions are done and they are in order. And also, if you are trading, it means that you need to ensure that your bookkeeping is up to date because the determination of amounts like that, amounts like that are going to be declared to SARS, provisional tax, income tax, they are dependent on accurate financial records, accurate bookkeeping, in short. So, yeah. Okay. All right. Does anyone have any questions?
Hi, Tendai. Earlier we had Lawrence Nefale who was asking specifically for the difference between your tax number and your VAT number.
Okay, so that's for a company because a company is the one that's registered for VAT. So basically there are two, with every tax type, right? There is a different, if I want to put this technically correct, I would say there's a different tax number. So a VAT number is the number that you get after you have registered as a VAT vendor, and an income tax number, which is your tax number, is the one like when you register, initially when you register a company, you receive notification from SARS to indicate that, okay, this is your income tax reference number, which is the difference between the two. VAT relates to VAT, which is a different tax type, And income tax is also a different tax type. So that's how those two are different. I'm not so sure if I answered you. Yeah.
Yeah, also maybe just to add on, VAT, you register for VAT either voluntary or when you reach the threshold. So, but income tax number, immediately when you register a company, you have an income tax number. So that's the major also difference there. So VAT, I think we are going to have another session that we talk about VAT, but the tax numbers are different, like what Teda has just said. If you are a VAT vendor, which means you qualify as a VAT vendor. If your turnover reached 1 million, you qualify as a VAT vendor, and you are mandatorily have to register for VAT. But VAT from word go, you are not mandatorily required to register for VAT. Okay.
All right, thank you. We have Karinda with a question as well.
Hi, good morning. Thank you for the informative session. I really enjoyed it.
Thank you very
Okay.
much, Karen.
Yeah.
Pleasure. Okay, so my question is, with provisional tax, we have the first and the second submissions, okay, and then the penalties we said. So the thing is, if your first and second returns are made late, there will also be penalties attracted to that. Am I right?
Yes. If you
Okay.
submit late, yes, there are late submission penalties. Yeah.
Okay. So what happened with my clients is they were having accountants that were not keeping track of their things. And they didn't, but the client also neglected to keep good records. But so the accountants did not submit anything for the provisional returns. And then as the time progressed and the year end came and the deadline came, then we realized what has happened. And then they went and they restated the provisional returns for the individuals. And it was quite big amounts. And then it triggered late payments because of the provisional tax must have been paid back in the day. And now the question is it maybe wise to go and request for correction for those provisional returns and restructure the whole thing? Because what also happened is the one company, one of the expenses were not in the books. So there's a material misrepresentation as per the accounting or auditing standards. So yeah, it's the client ended up paying around 100,000 in interest. So for me, I want to try to help them to get that down. And so yeah, I need to know, can I change the provisional returns for 2023 year again and maybe put a third return in to make the top-up payment, which then won't attract penalties? Or what can we do?
Okay. Sorry, Male?
I can take that one.
Okay.
So I think for this one, we need to understand the circumstances around everything, if I hear you correctly, because remember, third provisional tax is done. You need to make sure that it's done on time. Otherwise, there's no third provisional tax. So we need to understand, did they do the income tax return already or not yet? So I think we can have a separate call, if you don't mind, book with Hazel.
Okay.
And we can have a separate call. Then we can assist you in 30 minutes to say what's the way forward in your case.
Okay, that would be nice. I would appreciate that.
Yeah, so we can just
do-
do that one because of also time. We
Yes,
left
yes.
with 5 minutes. We're going to help you with that one. So you can just book that one with Hazel.
Okay, book with Hazel. Okay, I'll do that.
Yeah, so you can send Hazel private your email address, then she can slot you in, then we can have that call.
Okay, thank you.
Okay, thank you. Thank you very much. So I think if you have any other question, you are welcome to send through the questions to Hazel or to anyone. able to
We
assist.
do have another question. All right. Aubrey is asking that if a new client comes in right about the time that they were supposed to be submitting a provisional tax and they haven't been keeping any proper accounting records, what could we base our provisional tax on?
Okay, all right. So basically, with provisional tax, right? Provisional tax is an estimate. So if your first provisional tax, I wouldn't want to waive and say you don't need to have your bookkeeping in order, because that also helps you in avoiding penalties at the end of the year and also reducing the cash flow constraint for your second provision, where you have to now make a huge amount for second provisional tax. So they can declare an estimate unless otherwise SARS comes back, but that is in rare circumstances, if I can put it in that way, where they would want you to substantiate your amounts that you used to determine the taxable income for to determine your taxable income for the first provisional tax. So my recommendation would be to ensure that the bookkeeping is up to date. However, you can estimate, if you're running out of time, you can estimate the first provisional tax and pay, but ensure that when you now determine your second provisional tax payment, the bookkeeping is now done. I'm using the assumption that 2023 is the first year of trading. So, sorry, 2025 is the first year of trading. So which means that ensure that if you have estimated your first provisional tax payment, although it's advisable to ensure that you're estimating on the correct amount, you need to ensure that the second one is done on time to ensure that your bookkeeping is up to date, and also avoid penalties for underestimation, and also to be able to be ready should SARS say that, how did we determine to say this taxable income for this particular entity is this amount? So first provisional tax you can declare, although because provisional tax is an estimate. Second provisional tax, you need to ensure that it's based on the accurate accounting records, and also ensure that it's done at the correct time. Yeah, that would be my recommendation on that. I don't know, Molen, do you have anything else?
No, I think you've answered it well, Tendai. I see another question on the chat that can I use my management accounts? Definitely, because management accounts are the ones that help you to determine what's your taxable income. Remember what Tendai has said, taxable income is your income less your expenses that are taxable in nature. Not all expenses are taxable, but that's another session when we deep dive into what is deductible that we are going to have. So, but yes, you can, you have answered it well. Thank you. I think in the interest of time, we can move to the next slide because we are wrapping out now. If you still have any question, you're welcome to contact us and we'll be able to answer. So the next slides, I know Tendai have pretty much touched on individual tax, provisional tax, but we are going to talk more about the individual income tax submissions. I know we had about 32% who are individual. They want to know exactly how do you do your individual tax submission. So tune in and register for this webinar. Remember, we are in the tax season now. It's ending October. So we are still on time on your individual tax submission. So we are going to have a webinar separately talking about individual income tax submissions. So thank you for that. If you can register, I think Shane can send a link on the chat. Also look out for the following: tax saving, which is very, very important as a business. How do you save on tax? So the individual income tax submission is on the 23rd of August. Then the tax savings is also on the tax where we're talking about incentives for companies. You know, there was the solar recently and different kind of incentives, ETI and all those kind of incentives that as a small business or even as a business you can tap into. We are going to have a separate webinar talking about that on the 6th of September. And also we have another webinar. Understanding financial statements is crucial because we've seen that if as a business you don't understand your numbers, you are likely going to make decisions that are not based or that are not aligned with the numbers that are in your books. So understanding financial statements, whether you're an accountant or not an accountant, it's your duty, especially if you are running a company. So we are going to have that webinar on the 20th. So all the links are there. You will be able to join in as well. So thank you very much. I hope you got helpful tips from this presentation, and we hope to see you in our next webinar. Thank you.
Okay, thank you. Bye.